We've seen Indian markets in a bit of a roll in the last session in particular. Seth, what do you make of it?
Well, it sounds like we better rush and get our vegetables.
Well,
It's certainly robust right at this moment, but we've seen this kind of sentiment-driven kind of market before.
Good morning, Seth. I'm just, I won't get into specifically just the Indian markets. We've seen this happening to Romania, Turkey, everything. Usually when markets start to gain momentum, you find a lot of absolute return funds, funds that really don't care which part of the world is moving, but that they can get that 15–20% on the pop or the flip, start to get in. Is it possible, Seth, that kind of phenomenon could play out? Because India also just relatively feels safe. You're not investing in Burkina Faso. Could we have a lot of hedge funds or absolute return funds really pushing the market even higher?
Of course, we see money being piled in waves, and it just takes, actually sort of a small hiccup or some small policy announcement to change the sentiment. But, many of the larger funds cannot participate in these other frontier markets and can't really participate in these Indian small and mid-cap companies that have gone up so fast because there's just not enough liquidity. You were mentioning earlier about the role of market impact based just on sort of order size and certainly order selling size. And so a lot of the larger funds just can't participate because they need to put such large amounts, relatively large amounts, in the market at any given time.
Seth, just going beyond what may happen on the markets in terms of momentum, what's your general thought in terms of, Abha asked me this a couple of times in the mornings, I'll bounce it off you, valuations. And I'll talk about relative valuations rather than absolute valuations because, as compared to the US and in dollar-denominated basis, it's always a challenge because the US market on a dollar-denominated basis has been on a roll and, many emerging markets haven't really come close to it. But your thoughts, can that change or do you think the US markets will remain the focus?
The world has changed quite a bit because of passive investing and the number of index-based ETFs and ETFs being used as a portfolio of ETFs, almost the way that a fund of funds manager would allocate to different funds. And so you see investments going around the world just basically based on allocations in these passive investment products. And so that's changed it changed the dynamics and actually, I believe, the market structure quite a bit. So in terms of India specifically, we've got a number of global US and European, Hong Kong, Singapore ETFs that are really pushing the markets. And they have to stay invested. And unless they get, obviously big redemptions. So, this is where I think that we'll see a little more market stability than we would expect. But I don't think it's all, basically limited to the US.
Okay, what are some of the near-term triggers you're watching out for globally as well, Seth? Because we were also discussing how perhaps India seems to be a little on its own trajectory for the moment. What are some of the near-term triggers, though, that you are tracking?
Well, I'll tell you, it's pretty quiet here. This is the week leading up to Labor Day, and the day after Labor Day really does trigger the end of summer. And I think we're going to see significantly higher volumes after Labor Day, and those will have greater impact on the market. You're going to have traders and their bosses back. They're going to be also so besides being back to work and they've got to trade, they're going to start looking at the next quarter and looking at how things might look at the end of September. So we might begin to see some window dressing relative to allocations globally, including India. And I think that might be very positive, especially for Indian large cap companies.
One of the things, Seth, we have to also look from an Indian perspective is that interest rates in India, maybe because of inflation or whatever else, are still exceedingly high. And many people or companies use the stock market as a way to collect cheap capital. And we've seen a sort of a boom coming in IPOs, especially in banks, new banks and all, but it's still not a flood. And as we know, Seth, that till the time there's too much paper floating around, markets don't usually stop. Do you get the feel, Seth, that we could see the Indian IPO market really start to boom? So we perhaps may get 11, 12,000 on the Nifty first before we adjust 30, 40% downwards, rather than adjust downwards now. I'm just talking about the flow of money basically taking or pushing the markets up.
Yeah, well, if you look at some of the more recent IPOs, there's been relatively high interest, but nothing like several years ago. I believe investors are really much more focused on valuations, and of course, there are foreign investors who want to flip these stocks, but I think because of passive investing, there's more interest in longer term holding, and this is all going to be a function of earnings and estimated earnings and quality of management, but also sort of ongoing policy reforms and changes in India. I think that most investors that I speak to are as concerned about the mid to long-term impact of policy decisions as they are, let's say, concerned, because they're not so concerned about quality of management.
Seth, the sign of a bull market also means that we start to see flows from equities into real estate, into commodities. Now, in some markets, we've seen equities flow into real estate, like Hong Kong, maybe Singapore, actually the United States, and of course the UK. People in the Middle East and India and Pakistan and all these places love the UK, so I'm sure they were thrilled with Brexit. I love the UK as a real estate investment. I don't know otherwise, but I'm just saying. But what we've not seen in India is money moving from equities into real estate or commodities. In fact, the real estate markets are in big trouble, and most developers can't even sell the stock they have. How do we explain that phenomenon, Seth? Because a very strong bull market should indicate some flow through.
Yeah, and it sort of defies this whole demographic dividend story. There's certainly heavy demand for housing. Prices, it's very difficult for developers to reduce price, because their entire construction development thesis and their underlying financing and their hurdle rates are based on their pro formas. And I think we still need to see a rationalization of certain pricing. If you remember, going back 4 or 5 years ago, real estate really took off. It was the safe haven, and prices went up quite heavily. So on the other hand, sometimes it takes time for inventory to burn off. And what happens is, when there's excess inventory, building slows down, the inventory gets picked up, and suddenly there's not enough supply to meet demand. But long term, I can imagine that affluent Indians and Indians with rising incomes are going to continue to want to buy their homes. And you're right, it all has to do with the availability of reasonably priced long-term financing.